Okay, well, welcome. I'm glad you guys could join us for a little lunch and maybe a little learn today. We'll see how good I am. We have some folks online with us as well, so welcome to you guys that are online. And today we're talking about reverse mortgages and the home equity conversion mortgage, affectionately called a HECM. All right, so I guess I'd like to start off with just telling you a little bit of a story. My dad retired about 20 years ago, and it was a day much like today. And I got the privilege of picking him up from work and talking about how for the next, X days of his life, every day was going to be Saturday. Right? So is the dream of everyone is wake up today, and what day is it? Well, it's Saturday. You get to do what you want to do, right? So as you're going into your retirement years, you're trying to figure out, hey, can I do it? Can I live without my 9-to-5 job? And it's a big question that everybody has to face. And I think there's three things that you look at. You look at, what is your Social Security benefit that you're going to have? What is your nest egg that you have to help you live in your retirement years? And then your last thing is, do you own a home? And what is the situation with your home, right? So you have those three pieces to the puzzle. 20 years ago, I was in the mortgage business, so my dad would often talk to me about mortgages and how things were going. And his goal when he retired was not to have a mortgage. Unfortunately, he didn't meet that goal, but he had a small mortgage, and he had a good amount of equity in his home. And so, he felt good about that, but he had this mortgage payment that he had to deal with, and that was, probably his biggest burden in his retirement years was the mortgage that he had to pay. So about 5 years into his retirement, I got a call from him. It's like, hey, Dan, I'm starting to get concerned about my nest egg. My nest egg is going down a little faster than I would like it to. Social Security is Social Security. The only other thing he could control was his nest egg. So rates were favorable at the time, so I looked at refinancing them and pulling a little bit of money out. So we were able to pull a little bit of money out and keep his mortgage payment about the same. So now he's 70 years old, and he's going, hey, I got the next X years to live, and how am I going to do? Well, we had that conversation about every 5 years in his retirement, okay? And looking back on it now, I think we managed it pretty well. My dad's no longer with us, but I think he had a good retirement. But if I knew then what I know now, a reverse mortgage would have definitely been something that we talked about. At the time, it really wasn't something that I had an expertise in. And I think the reverse mortgage availability of products and things has gotten better over the years. I think they're more friendly to the consumer now than they were 20 years ago. But the principle of it is this: use your house like you would use your nest egg, okay? Your nest egg is there to help you live in your retirement years. Your house, most people view your house as an expense, a liability. It is not something that helps you live your golden years better, right? Most of the time, people don't leverage their home in the way that they can. And if I told my dad when he went into retirement that he didn't have to make a mortgage payment for the next 20 years of his life, he would have been a lot happier, right? So I think that's really what we want to talk about here today is your home a tool to help you live your golden years maybe differently or better than you thought that you could? And I think the answer is yes. So we're going to talk about, the myths of a HECM or a reverse mortgage, the benefits of it. And there's really two scenarios that I want us to focus on. The first scenario is, hey, how can I stay in my house and not have a mortgage payment? So that's one scenario. The other scenario is, hey, how can I buy the next house or the next lifestyle that I want to live, right? I think a lot of times people, especially here in the Chicago market, are looking to get a little warmer, especially as we are in this season now that we're entering the colder season of the calendar. And a lot of times people just don't think it's in reach. You know, it's like, hey, how can I move to Florida? How can I move to Arizona? How can I move to Tennessee? Is kind of a hot one these days. How can I do that? I have a very good situation with my house now. How can I have that in, you know, if I were to move? Most people don't think of a reverse mortgage as a solution to a purchase. And you can use a reverse mortgage to purchase a home and not have a monthly mortgage payment. You know, the goal, you know, of mine has always been, hey, I don't want to have a mortgage when I retire. You know, I don't want that expense. I think that's a good goal. It gives you options. But then it's like, how do I use my house to help me live my years? And it can be different for different people. I mean, for everyone. Your situation is going to be your situation, and you have to look at it that way. So this isn't a one size fits all, but I do think it's something that everyone can consider. And I think it's a good tool. I was out to dinner with some friends the other night. They're retired, newly retired, and I've done their mortgages over the years, and they were just asking me about how things were going, and they're like, hey, I want to fix up the house. I want to do all this kind of stuff. And like, we just can't afford it. And I'm like, well, have you ever thought of a reverse mortgage? And they're like, no, I would never do that. That was the first thing out of their mouth, right? So hopefully after today, at least you won't say that. No, I would never do that. Okay, I think you should consider it. So let's go through this presentation, and we have some questions at the end that you can ask, and we'll see how it goes. So, as I said, how can you have your equity of your home help you in your later years? People are outliving their assets. Social Security is often not not enough to live on. Or people have insufficient savings. They don't have a big enough nest egg. You know, how can you do this? So how can you turn off your mortgage payments? I think that's probably the biggest thing that people would like to do, is to turn off their mortgage payment. I think most people can see or can understand what not having to make a mortgage payment for them in their retirement years would do for them and how it could help them. So a home equity conversion mortgage can serve also as a line of credit. We're going to go through some examples of how much money you can get out of your house, but you can take the money in different ways. One of the ways you can not only have you don't have to make a monthly mortgage payment, but if you have equity that you can access, you can take a lump sum, or you could take a fixed monthly payment for the rest of your life. You could take a fixed monthly payment for a period of time, let's say 5 years or 10 years, and then you know that Social Security might kick in for you at a later time in your life. I think a lot of times people look at, you know, their login.gov statement now, right? If you guys don't know where your Social Security statement is, you should be looking at that. You look at it and you say, when I start my Social Security benefit, what is my payout going to be, right? Well, you can start it at 62, I believe, but the later you start your payment, the more money you get every month. Well, if you used your equity of your home, let's say for a 5-year period, and delayed your Social Security for 5 years, you'd be getting a lot more money in 5 years on your Social Security. So it's a vehicle that you can use and apply in different circumstances, and everybody's a little bit different. So it's not one size fits all, but it is something that you should use or consider using to help you navigate your golden years of retirement. Okay, so there's a lot of ways a home equity or a HECM can help you. So let's talk a little bit about the myths. A lot of people think when you take out a reverse mortgage that the bank owns your house. Okay, that's oh, I would never do this. My house is not my own anymore, right? Well, what is a HECM, a reverse mortgage? It is a home equity conversion. What's the last word? Mortgage. It's a mortgage. It's just like any other mortgage. It's a lien on your property. It has to be satisfied and paid off, just like any other mortgage. It is no different than any other mortgage. Now, there are some things that I think are unique that are actually to your benefit that I'll talk about a little bit later about. But in essence, that's all it is. It's just a mortgage. So if you have a mortgage, you know, bad news. You got to pay it back, right? But it's no different than any other mortgage, whether it's a forward mortgage where you make monthly mortgage payments out of your own checking account or whatever, or if you use your equity in your home to satisfy the debt, okay? So a home equity conversion mortgage uses the equity of your home to satisfy the monthly debt that's due, okay? It does that by growing the mortgage. So yes, your mortgage does increase. The amount of money that you owe does increase. But guess what doesn't deplete? Your bank account, right? It's a choice. What choice do you want to make? Do you want your equity of your home to make your mortgage payment? Or do you want your bank account to make your mortgage payment? It's your choice, right? And a home equity conversion mortgage is a way to do this. It's just a different way to use your asset to satisfy what you owe. So not only do you not have to make a monthly mortgage payment, you can access the equity that you have in your home through a line of credit that actually grows with you through the years of your mortgage. Okay, so I'll get to that a little bit more in detail, but that's a really great feature. Okay, so most lines of credit you take out, they the terms are set. You know, it's a $50,000 line of credit, and then you pay it up. You know, you use it like a credit card. You draw on it, you pay it down. You know, but your line is always 50,000. Well, on a home equity conversion mortgage, your line of credit might start at 50,000, but it can grow to 100,000. Okay, it can grow to 150,000. It grows every year with you. Okay, so that's a really nice feature because you don't have to like refinance and get a new line of credit. What did I do with my dad every 5 years? New loan. He loves me. Okay, so we got to hang out and do some paperwork, but it's kind of a pain in the neck, right? You have this built in and it grows with you. What a great thing. So what's the difference between a HELOC, a home equity line of credit, and a HECM, home equity conversion mortgage line of credit? So can the line of credit grow on a HELOC? No. Can it on a HECM line of credit? Yes. Is it canceled? Can it be canceled? A HELOC can be, okay? I don't know if you guys remember 2008 when we were in the housing crisis. The prices of homes and the value of homes crashed. And banks were sending you a letter saying, hey, your home equity line is frozen. You can't access it anymore because they were scared what your house was worth, okay? So it can be canceled. But a home equity conversion mortgage line of credit can't be. So once you set it up, it's there, okay? It can't be taken away. A HELOC requires monthly payments. A HECM line of credit does not. There is an age restriction. You have to be 62 years old in order to take out a reverse mortgage line of credit. Where on a HELOC, you can do it when you're 18, okay, as long as you own the house. So there are some differences there, but there are some benefits. So other things that you want to take into consideration. When you take out a HECM and you no longer live in the property as your primary residence, the loan becomes due and payable, okay? So let's talk about some examples of this and how it could go. Just use my mom and dad as their experience. And my mom wasn't of good health. If she needed to go into a assisted living place, she would leave the property, right? My dad was in good health. He would stay in the property. No problem. Loan's still in place, okay? My dad passed away before my mom. My mom stayed in the house. He was the breadwinner. She wasn't. Would the loan be due and payable? No, okay? Still her primary residence. Even if she wasn't on the loan, as long as it's her primary residence, she gets to stay in the house. No mortgage payments are due, okay? Now, my dad passes away. My mom needs to go into assisted living. No one that were the primary people who lived in the home are still in the home. Now, you got to deal with the reverse mortgage and you got to pay it off, okay? So that would be one difference between a HECM and a regular mortgage. A regular mortgage, you wouldn't have to deal with that. You'd have to deal with making the mortgage payment every month, okay? Just like any other debt, okay? But you wouldn't get to take advantage of the benefit of no monthly mortgage payment as long as you're in the home.
I thought that you could extend this loan for 12 months without being in the home.
Which loan are we talking about? The home equity conversion mortgage?
Well, no, I'm confused. You tell me, because I want to know.
Okay. Well, there is a transition period. They're not going to just, tomorrow you got to be out and pay it off. I think it's 6 months or so in order for you to take care of your affairs. But that's my understanding.
Is this with the HECM or is this with the HELOC?
Well, this is with the HECM.
Okay.
So the reverse mortgage this would only happen in a reverse mortgage situation, okay? A home equity line of credit or a regular mortgage, 30-year fixed regular mortgage, you just have to make the monthly payments. As long as you make the monthly payments, you can keep the loan, okay? The home equity conversion mortgage, the reverse mortgage, does have requirements for you living in the property, okay? So that would be the difference.
I did have a situation personally, and I think I know what you're talking about. So my mom lived in assisted living for a short period of time for rehab. All we had to do was let them know that she wasn't living in the house, and that was acceptable. So she was out for 8 months. Is that what you're thinking about?
Well, I was just told yesterday that you had spoken. So,
and it could be, mine was several years ago.
I'll confirm that.
Yeah.
I'll confirm that for you.
I appreciate it.
All right.
Excuse me.
Yes.
How much equity do you need to do that loan that you're saying?
How much equity in your house do you need to be able to do?
Yeah.
Well, we'll get into that, but it does depend upon your age. Okay, so if you're 65 or 62 versus 85, the older you are, the less your life expectancy and the more money that you can get out of your house. Okay, but I'll give you some examples. Okay.
I'm 75.
Yeah, I actually have a good one for you. Okay. All right. So you got to be 62 years old. There's no monthly payments of principal and interest. And taxes and insurance need to be maintained and paid. Okay. If you have not been paying your taxes over the last 2 years, you have to set up what's called a lifetime estimated set aside for the payment of your taxes. Okay. So that's probably the biggest thing that we look into is to make sure that your taxes and insurance have been paid on time the last 24 months. If they have been, no worries, you can keep paying them on your own. Okay? Yeah.
As far as like the last hour, how would that be impacted if, say, either one spouse passed or they got divorced and remarried? Would the second spouse still have the same rights as if they had been?
I believe so. I believe so. We can let you know for sure. But the idea is this is your primary residence. Okay? What for sure we don't want to see is, hey, you own 3 homes and you have 3 reverse mortgages. Okay? That's not what it's for. It's for your primary residence. Okay? So I think that kind of is the spirit of the law, the primary residence. And as long as you're in that spirit, I think you'll probably be fine. Okay?
How many years are you supposed to be on that house, because
One day.
getting in and out?
One day. It's just your primary. You only have one primary residence.
Yeah,
Right.
but how many can you do it also when you get in and out? Or are they looking at the years you stay?
So you stay here for 6 months and then somewhere else for 6 months? Yeah, you only still have one primary residence, right?
Yeah.
It's fine.
Oh, even if you live now and then get out again and then live again, so they don't count the years you have been living there or what?
I think I understand your question. So maybe your question is this. If you live in your home 6 months and 1 day a year, and the other 5 months and 29 days a year, you live somewhere else, right? That's your primary residence, okay? If you own 2 homes, you only have 1 primary residence, okay? You don't have 2. So you can do this loan on your primary residence, not on both residences.
Even when I get out, I have it rented out and then get out and then come in again and then have it rented out. So there's no,
If you're renting it out, then that's an issue.
No. I mean, I get out and then I come in again, and then I get.
When are
out
you applying for your home equity mortgage? When you own the home as your primary residence?
Before, and then I get out.
After you get out, we can talk more about that, okay? Yeah. So, like I said, everybody's different, okay? You guys can think about a lot of ways to wreck the mousetrap for me, okay? But we'll get at them. All right, primary residence, non-borrowing spouse can be younger than 62, okay? So borrowing spouse is 62, other spouse is 60, you can get the home equity conversion mortgage, okay? So like I said, it has to be your primary residence, and then there is a financial analysis that's done, okay? It's a different qualifying than for a regular mortgage. Basically, it's this. We look at your inflows that you have and your outflows that you have, okay? If that's a positive number, you're good to go, okay? It's pretty simple. If that's a negative number, then we have to get a little bit more creative. We could maybe use some of the equity that you take out of your home to help your cash flow, and then that number might be a positive number, then you would qualify. So there is a financial analysis that you go through when you take out a home equity conversion mortgage. It's not just, hey, I show up and I get the loan, okay? So there's a little bit of comparison. So how can you take the money? I talked to you guys about this. You can take it as a lump sum. You can take it as a line of credit. You can take it as level payments. It's called a 10-year, which is for your lifetime. Or you can take level payments for a term, specifically like a 5-year term or a 10-year term. Or you can take a combination of those, okay? So we're pretty flexible in letting you access your money that's yours, okay? So your equity, remember it's equity conversion. We're taking the equity and we're putting it to work. So this is how we can put it to work in addition to no monthly payment, okay? So that's a pretty nice deal. Single family residences, 2 to 4 units properties, as long as you live in one of the units, okay? So can't be a rental property, 4-unit rental property, all 4 units are rented, okay? Even if it's your only property, all right? You still have to be using the property as your primary residence. Manufactured homes are okay, planned unit development homes are okay, and FHA approved condos are okay. A little side note, this is, the loan we're talking about here is a government insured loan. There is mortgage insurance with this loan, and we do have to follow the housing and urban development guidelines, okay? So I talked about this earlier with your taxes and insurance. You got to be on time for the last 24 months, or we have to set up an account to pay your taxes and insurance for the lifetime of your mortgage. So we do a life expectancy calculation. We set aside some money. That money is set aside. You cannot access it, and it's used to pay your taxes and insurance for as long as you're alive. Okay? Yeah, go ahead.
Is there a, like, if you live downtown, is there a location on this that prohibits it?
Well, it has to, if it's a condo, it
Yeah.
has to be an approved condo. Doesn't matter if it's downtown or in the farmland.
Okay.
It's not a geographic situation. It's just, if it's condominium, there's a condominium approval process that we have to check out. Make sure that the condo is okay. Just like you would with any other mortgage. Okay? All right, let's look at a case study here. So this is if you were going to basically do a refinance of your home that you already own and you're 65 years old, okay? So let's talk about the options. There's 3 options up here. Let's see if I can use my pointer. So we got 3 options, okay? We got a 2.5% margin, a 2.65 margin. So this is an adjustable rate mortgage. These 2 are adjustable rate mortgages, and then you have a fixed rate mortgage, okay? So the index is the 1-year constant maturity treasury, CMT, 4.72. The margin is 2.5 on this one. On this one, it's 2.65. So the effective rate is 7.22 or 7.345. These are just choices for you, okay? There's mortgage insurance, like we talked about, it's 0.5%. The expected interest rate is based upon the 10-year constant maturity treasury. This is an estimate. This is not real life, okay? We're just trying to tell you over the 10 years what we think it will be closer to. There is a rate cap, which is 5% over the start rate. So if you look at 7.22 and you add 5% to it, the rate cap could go up to 12.2. This is the initial credit line growth rate. So we talked about that your home equity line of credit on a HECM can grow the amount of your line, okay? So the amount of your line growth rate right now is roughly 8%. So we're saying a year from now, if you took out a $100,000 line of credit, your line of credit a year from now would be $108,000, okay? And then it compound for the next year. But that growth rate can change. All right, and on your statement, it tells you what that is. Okay, so you've got two options on your adjustable rate mortgage. So the adjustable rate mortgage, the rate changes every month, but the cap is 5%. It can't go up more than 5%. Or you can take out a fixed rate, which is the last column. Okay. So monthly service fee, there isn't any. Home value. So the home value in this example is $700,000. The home value limit is set by the government. So that the government says, hey, you can't take out a mortgage on a HECM for more than $1 million, a little over $1 million bucks. Okay. So you look at the lesser of the home value or the home value limit, which is 700,000. And then this on this scenario, if you're 65 years old, you can take out $264,000. Okay. So that's the $264,600. Then in this scenario, you have some closing costs, which are a little less than a point for your origination fee. And then there's other closing costs, about $6,000. You have mortgage insurance, which is $14,000. And then you have some other estimated closing costs. Your total closing costs are $22,000. So if you owned or owed $200,000 on this property, you would walk away with $42,000 and no mortgage payment. Okay. So this example is somebody that has a $200,000 loan on there and they're making mortgage payments right now. So they're getting rid of their mortgage payment, which is roughly $1,000, and they're pulling out $42,000. They can take that as a lump sum. They can take it as a line of credit. The first year, you have the availability to get a little over $26,000, and then the subsequent years, you can grab the rest of it. So that's how it would work. So this is an example of somebody who's 65 years old, owes $200,000 on their house, and the value of their home is $700,000. So why would they do this? They would do this to eliminate their monthly mortgage payment and to grab a little bit of money. Okay? And to have a line of credit maybe in place that grows at a rate of $8,000 a year, as long as they have this mortgage. So it's planning for your future. So look at my dad's situation. He came and saw me every 5 years to pull out money. Okay, if he had this in place, he wouldn't have had a monthly mortgage payment, and his line of credit would have gone up $8,000 a year. He could have grabbed another $8,000 every year in his retirement. So that's why you do a reverse mortgage. You're setting yourself up. Remember, we have our Social Security, we have our nest egg, and we have our house to help us through our golden years. So how can you use your house and convert that equity into money as opposed to it just being a liability for yourself? Yeah.
If the home value, when you did this 700,000, home values are increasing, does that allow you to take more money? Or are you fixed and set only on these numbers?
You could redo a loan. So you could refinance it with a new one and get the new value, okay? But when you do put this in place, this is your universe you're living in, okay? So remember, this is 65. This is now the same example, but at 75 years old, okay? So this one, they have $87,000 to work with, as opposed to $42,000 to work with when you're 65. So that's why it's different for everybody. Okay, so depending upon how old you are, you know, your situation is going to be for you. So that's 75, and here's 85 years old. So you can get 161,000 if you're 85, right? Same example, just 3 different ages. All right, so 85, or excuse me, 161,000, 87,000 bucks, 42,000 bucks is the main differences there. 75 is 87,000 bucks. But this is, what you need to do is you need to talk with one of our loan officers and we need to run your scenario. Okay, I'm just trying to give you some what ifs, right? So that you can see how it could apply to you. All right, purchasing a house. So this is one of the things I think that a lot of people miss. We talk to a lot of people that are transitioning in life. They're moving to Tennessee, they're moving to Florida, they're moving to Arizona, and it's like, hey, how am I going to live in my next years? Am I going to have a mortgage? Am I not going to have a mortgage? How am I going to deal with my house? And they don't look at a reverse mortgage as an option, unless we bring it up to them, right? Say, hey, look, do you want to make a mortgage payment? No, I don't want to make a mortgage payment. Like I said, everybody's goal is to not have a mortgage payment, right? So if you could move and buy a house with a reverse mortgage and not have a mortgage payment, it might open up a lot of things for you, right? A lot of times you're looking for a certain lifestyle in your later years. I want to live in a 55 and older community. I want to have all these amenities, and that comes with a price tag. So even if you own your house outright, let's say you own a $400,000 house in Illinois, and you want to buy an $800,000 house in Arizona, okay? You sell your house for 400 grand, you put that 400 grand down on the $800,000 house. Now you have an $800,000 house, okay? That's appreciating as opposed to a $400,000 house that is appreciating. You still have the same equity, 400,000 bucks. So why wouldn't you want the $800,000 house with no mortgage payment? Just like you had no mortgage payment on their $400,000 house, and you have the lifestyle, and you live in the climate, and you got everything that you're trying to accomplish. Most people would say, hey, I got to go find a $400,000 house in Arizona and pay cash for it. Well, that's an option, and if you can make it work, great. But you also have the opportunity to expand your horizons and get a bigger house or a house that suits your needs in your retirement years. So I hope that you really think about it differently and think about that this is an option for you to consider. So, yeah.
So you sell your $400,000 here.
Yep.
You buy the $800,000, you put down 400.
Yep.
You owe 400, so you need a loan to come up with that extra money for the 400.
Right.
How are you doing that with a reverse mortgage? You've already used the whole value of this home and used that for your down payment.
So let's just think about it this way. You sold your house for 400,000 bucks. You got 400,000 bucks in your pocket, right? You're going to buy a house for 800,000 bucks. You're going to get a mortgage for 400, and you're going to get 400,000 out of your pocket to put down. So you have a mortgage for 400,000. That mortgage is a reverse mortgage. No mortgage payment. There is no line of credit or anything because you're just putting down the 400,000.
So the payments to pay off that 400,000 are coming from the equity.
Yep.
So each year you have less and less equity in it. Then.
Correct. But you also have a home that's appreciating, right? And I'll show you here some scenarios. With reasonable projections, you really don't eat into your equity. Like a 4% appreciation rate. If you have a 4% appreciation rate, your equity will pretty much stay intact. So it's a choice, right? How do you, like I said, the thing we talked about is this is converting your equity into cash, right? How do you do that? By not having a mortgage payment, right? So it's really the same thing for this person. Hey, I live with no mortgage in Illinois for $400,000 house, or I buy an $800,000 house. I have a $400,000 mortgage, same equity, but I don't have a mortgage payment. Most people don't think that way. They think, hey, I got to go take out a mortgage and have monthly payments. I can't afford the monthly payment. I don't want my nest egg to be dwindled. Now you can keep your nest egg, and have no mortgage payment and have an $800,000 house, have the same equity, and you really have a better appreciation formula. I'd rather appreciate an $800,000 house than a $400,000 house, right? So you're using your equity and you're converting that into opportunity. Yeah, question.
This money doesn't have any impact on your taxes, like what about capital gains and all?
Well, capital gains you would have to deal with when you sell your house if you weren't reinvesting it into a primary residence, but you are, so you don't have any capital gains. So don't get caught up in this being a reverse mortgage. It's a mortgage. Same questions apply. You're just taking out a mortgage. The repayment of the mortgage is different. And the repayment of the mortgage is what allows us different opportunities with the reverse mortgage situation. And then you have the benefit of the line of credit as an option, which grows with you through your lifetime. You don't have to reapply to get a new limit, right? So that's, I mean, this is really a life-changing thing for many people, right? And it's something to be considered. And everybody has a different circumstance, and that's why you need us to help you figure it out, right? Yes.
So let's say you aren't able, let's say we have another situation where you take out the reverse mortgage and then we have another 2007, 2008 where the home prices then basically vanish.
I was wondering.
So yeah, what happens then? I know the growth rate is locked in, but does that eat into the equity then essentially for shares?
Well, I mean, you got a lot of questions in there, okay? So let me unpackage them. No one's going to knock on your door. That's what you're worried about. Does anybody knock on your door when your house goes from $800,000 to $400,000 in value, and you have a $400,000 mortgage or a $600,000 mortgage? Let's say you have a $600,000 mortgage. You bought it and it was worth $800,000. Okay, now it's worth $400,000. Does somebody come knock on your door and say you're upside down $200,000? What are you going to do?
Well, right, you don't have
No.
issues until you go to sell it, but I guess like when you're talking about people that are seniors that may be going into assisted living facility
Yeah.
at some point in the future, if that happened, like if they would just have bad luck and bad timing.
Yeah.
What is that? Is there ever any?
You got a great question. I have an even better answer for you. There's mortgage insurance on your house. The mortgage insurance kicks in if you're in a negative situation and your heirs don't have to pay it. So you sell your house and you're upside down, you just pay off the value of what you sold it for. The difference gets paid by the mortgage insurance. Remember that big number in that thing? It was like $12,000, $14,000 that you had to pay up front for mortgage insurance. That's what covers. So you're living good. You can smile again, right?
So is that something that works then if you exceed the value of your home, but you're still alive and in the home and you don't get kicked out, you stay there?
Yeah.
And you keep getting payments.
Yeah.
Right?
Yeah.
So, okay.
Yeah, it's a good deal. Right? So there's a lot of smart people in the world, okay? We go through and we figure out life expectancy, we do averages, I mean, actuarial tables and all that stuff, right? That's all in this. And we're not in this to lose money, okay? But we mitigate the risk. We understand what we're getting into. This is a good product. And you as the consumer have some rights and you have some protections, and it's a good thing, okay?
I have a question. So we're real estate agents. So if somebody were to exhaust the equity in their home because they've lived just way longer than anybody expected them to, and so at that point, the home then gets sold right? And that
Are they alive?
No, everyone has passed that
Uh-huh.
was in the home.
Yep.
Then the house gets
Sold.
sold
Mhm.
and the money goes to pay off
The
what they
mortgage.
owe,
Yep,
whether it's enough or not.
correct.
Okay. How does that work with a real estate agent? Who does that? Where does the money come to pay for the real estate agent? Does it come out of the proceeds that would go to pay off that loan?
So are you saying if you list a home that's upside down, are you going to get paid?
Yeah.
Yeah, it's a good question. I think it depends on,
Well, how does it work? You must have had that situation. What would happen?
well, in a regular mortgage situation, that's called a short sale.
Yeah, I know
Right.
that, but this is a little bit different.
Well, not really. This,
So that's what I'm asking you then. Is that what you would treat it as a short sale and
Mhm.
agree, the lender and you would come to an agreement of how
Yep.
you're gonna handle it?
So, I mean, you deal with it. Okay, but the heirs, I think, is one of the things that we can address here today. The heirs are not going to get stuck. And that's what I think a lot of people are scared of. It's like, hey, I don't want my kids to be dealing with a negative situation. And they're not. Because in no way is there anything, they're not on the hook for anything more than what they sell it for. Because the mortgage insurance kicks in.
So let's say it's not the disaster where.
Yeah.
We've got a good situation, but the parties are both dead. Kids are somewhere. Okay. So now what happens? It gets sold. Is there legacy money for the heirs?
Sure. Yeah, if it's just like any other mortgage, if once you satisfy the debt, the balance goes to the heirs.
So after the mortgage is paid off, if there's residual money, the kids get something.
Yep,
Okay.
same thing. Remember, it's a mortgage, just like any other mortgage. It's a lien on the house.
Tom Selleck says it's just how you pay.
That's it. He's not as good looking as me, though. Oh, he's not agreeing.
I'm just laughing.
For example, if in the later future, that house will be lower in value, so will you be able to, so where will you get, even in the future, that house will go down in value, so will there be some more money? Or you have to put more money now because the value went
Now,
down?
once you take out your mortgage, you're set, okay? If your home goes down in value, you still signed up for a certain type of loan. That doesn't go away, okay? What we're talking about is when you no longer are living and the property has to be transferred,
Okay.
okay? Then you have to probably sell the house because there's no primary residence, right? And then if you're upside down, the mortgage insurance pays the difference between the price and what you owe. So your heirs won't owe any additional money.
The situation now, when I bought the house, and then with all these riots that came in, then the value went down.
Yeah, well, the point is that this mortgage isn't going to be a bad thing for you. It'll be just like any other situation, okay? Now, if you had a regular mortgage and you were upside down on your mortgage,
Yeah, that's it.
well, they'll do a short sale and then you'll have to deal with it. So this is better actually for your heirs than if you had a regular mortgage on the home, because the mortgage insurance pays that shortfall. Okay. All right. So let me see if I can highlight a few things here. So this is the next 25 years of your mortgage. all right? So this scenario is on a purchase and you're 75 years old, okay? When you start, your loan balance is 199,000. In 7 years, it's 335,000, okay? If you take a 4% appreciation, I think is what it's used somewhere, another, I'm pretty sure it's 4%. Right there, okay? In year 7, your equity is still 256,000 bucks, okay? So that's a big concern that a lot of folks have is like, hey, my loan balance went from 199 to 335 bucks, 335,000 bucks. I don't like that. I don't want my kids to have to deal with that, right? But at the same time, your home is appreciating and your equity is still the same. So you're doing a good thing and you're using this money to make your payments. Okay, instead of your nest egg being dwindled, your loan balance is going up. Okay, so it's a choice. You want your nest egg to go down, or do you want your loan balance to go up? Yeah, it's your choice. Okay, but most people don't think about this as an option. Okay, because they're scared that this, that this is going to be a bad situation, right? Your net equity. I don't want my kids to have to deal with something. Now, this just shows you that it's not necessarily bad. It's a choice. It's an option. And for you, in your years that you're living, you know, how does your life change if you don't have a mortgage payment? That's the question that you can answer for yourself and no one else. But it's a good option. All right, I think I'm going to wrap up here with 2 simple examples. This is purchasing a home, right? You have cash reserves of 400,000 bucks. You want to buy a $200,000 house, okay? You have 113,000 that you can get from your reverse mortgage. So after you have your 400,000, you buy a house for 200,000, you get a reverse mortgage for 113,000. You now have reserves of 313,900 bucks. Okay? Or you can go pay cash for a house. You have 400,000 to work with, you buy a house for 200, costs you 1,000 bucks, you got 199,000 bucks left. So this is what you can answer your own question on. Is this significant for me? Having 313,000 bucks versus 200,000 bucks. And you have no mortgage payment. So you have no mortgage payment in both scenarios. What's better for you? And I just think that that's worth your consideration, right? Another way to look at this is a little bit more Pollyanna maybe, but let's say you sell a house for $1 million bucks. Okay, everybody wants to do that. And you're gonna buy a new house for 600. You can get a reverse mortgage for 435,000 bucks. You can put down 165,000 bucks, and you still have $835,000 left. Or you'd have $400,000 back left. So this is a way to have double the reserves, the same house, and you use the equity of your home to help you live in your golden years. You got no mortgage payment and you got a lot more money in the bank. Right? Is that worth your consideration? I think it is. So 2 scenarios I wanted you to think about is how do you stay in your house, not have a mortgage payment? We talked a lot about that. How to use the line of credit, how the line of credit grows. Your heirs aren't going to be hurt. It's a good thing. And should you consider purchasing a home with a reverse mortgage? I think the answer is yes, right? All right, you had a few questions along the way, but any more that you might have now?
Yeah.
Okay.
So how much equity does somebody need to have in their home to be able to consider this?
Yeah.
And you mentioned like needing to have a positive cash flow to does that include their current mortgage, or does it need to be positive once that mortgage payment is frozen?
Okay, so a few questions there. First question is, how much equity do you need in your house in order to get a reverse mortgage? The answer is it depends. How old are you? 65, 75, 85? You know, so we talked about each one of those has different scenarios, all right? So you need to talk with the loan officer and they can tell you for your circumstances what you can do. Let's see, what was the next question you had on top of that?
Cash flow, I think.
Oh, cash flow, yeah. So the cash flow is outside of the mortgage. There is no, if you take out a reverse mortgage, you don't have a monthly mortgage payment. So it's, what are your other bills other than your mortgage payment? Okay, car payment, you know, credit cards, whatever they might be. What are your inflows? Social Security, nest egg, that kind of stuff. That monthly inflow needs to exceed your outflow. That's
So
pretty
it's
much
like,
it.
talk to clients and it's like, if you didn't have that mortgage payment, you'd be fine.
Yeah. Well, now that's basically what we're saying. If you didn't have that mortgage payment, you'd be fine. This is a good way to get there. All right. Any questions online?
None online.
None online. Hey, I did pretty good. All right. Well, there's a few LOs around here. If you guys have any more questions, we'd be happy to answer anything that you might have and hope this was beneficial for you. Thanks for coming.